Welcome to episode 8 of the Maveric Banking Edge podcast series. Today, we have Effie and Avinash, seasoned wealth management experts, hosted by P. Venkatesh, Director, Thought Leadership at Maverick Systems, to cover our latest report on redefining the role of financial advisor.
Welcome to the next edition of the Maverick Banking Edge podcast on redefining the role of financial advisors. I have with me today Effie Pailarino, an investment banker turned a leading architect in the fintech area, especially around investment banking and capital markets. She has been a pioneer leading a number of podcasts, articles, blogs, and whatever. Effie, thank you very much for joining this session.
Thank you very much. It's a pleasure to be with you and discuss these topics today.
Thank you, Effie. And I also have Avinash, who has spent more than 2.5 decades on the capital market side and has engaged with wealth management firms across the globe, whether they be private wealth or investment management firms, and also asset management firms. Welcome on board, Avinash.
Thank you, PV. Thank you.
Effie, the title of the report is Redefining the Role and Function of the Financial Advisor. So I wanted to ask you, what are the drivers, both technological and macroeconomic factors, that is making this redefinition and change of role necessary of financial advisors?
Absolutely. And as you said, it is necessary both because of the technological advancements that are affecting all industries, all businesses. And we're talking about cloud, mobile, and now AI. Those are the technologies that are changing how businesses operate and how they serve customers. And that's the same for financial advisors. We also have important demographic shifts that are underway that affect who they serve and how financial advisors serve their clients, as we have the younger generation that is much more digitally native. And on top of it, they have different values. Those value shifts are the other important factor that financial advisors have to take into account. For example, ESG considerations are very important nowadays, not only because of the mindset shift, but because they are becoming important business risks, and financial advisors need to adjust to these new realities. And the way they need to adjust will change both their operational workflows, but also how they serve their clients.
Very nice, Effie. In fact, that brings up the next question too, Effie, as a corollary. How does these drivers change the financial advisors' engagement with their clients in terms of their operations, as well as in terms of complying with regulations?
Great question. First of all, I want to remark and emphasize that the shift to digital, which is the current reality, and financial advisors can't ignore that, that does not mean that there isn't a human contact and touch point between the advisor and the customer, the client. Actually, it means that there is a different way of engaging with the client and the customer. And financial advisors need to adjust to this new reality. What does that mean? It may mean real-time insights. It may mean customized insights. It may mean providing financial bits of financial education, and especially, for example, in the new asset class of alternative assets that is not only becoming more of interest to the new generation, but it's also growing and including cryptocurrencies and digital assets. These are new assets that financial advisors will have to educate their customers for. So that's how it is changing the way they interact with the clients, but it's also changing how they work behind the scenes because we have more intelligent tools to be able to adapt to the ever-changing and growing regulations. So financial advisors will have to also adjust to the fact that their clients may need auxiliary services. They can become concierge. So it's the whole world is changing. And I want to give a very concrete example from recent surveys and statistics where Charles Schwab is looking at the ETF world, which is, because of fintech, one of the most prominent investment vehicles, and financial advisors use them. What they have seen is that ETF investors are more interested to invest not only in equities, that's the top asset class, but equally in cryptocurrencies. And their interest is at the same level, cryptocurrencies with fixed income. So this is the world that financial advisors have to serve in. And as I said, education, customized uh, insights, real time, contextual. That's the world that they need to work in. And they need to integrate technology behind the scenes so they are empowered to be able to serve at scale in this different way.
Very nice. Effie? See, Avinash, Effie did mention about the technology changes as well as the alternative assets coming into play. Now, I really wanted to ask you, how does Gen AI, ML, and tokenization change the very role of financial advisors, and what are the benefits and challenges with regard to them?
Correct. So let's understand how emerging technologies like Gen AI, machine ML, machine learning, and tokenizations are really shaking things up for financial advisors. These advancements are making it possible for advisors to deliver highly personalized advices by analyzing vast amount of client data, everything from financial goals to risk tolerance. They are getting deeper insights into what clients really wants and how to shape strategies around that. Right? Take generative AI. According to Bloomberg, this market is set to grow from $40 billion in 2022 to say staggering 1.3 trillion by 2032. So AI is transforming the game by helping advisors make smarter data driven decisions. And also then you have robo advisory advisors, which are another big players over here. They are automating a lot of the routine stuffs like portfolio rebalancing, tax lot harvesting, which frees up advisors to take what really matters. I that is focus on building relationship with clients and providing the personalized touch that cannot be automated. If we talk about tokenization, this technology is a total game changer, I would say. It's breaking down high value assets like real estates and private equity into smaller, affordable pieces. For example, HSBC recently issued tokenized gold, allowing investors to trade digital tokens that are backed by real physical gold. And looking ahead, McKinsey estimates that tokenized market could hit $2 trillion in market capitalization by 2030. This opens up more opportunities for clients to diversify their portfolios with assets those were once out of reach for them. But of course, with I would say with new technologies comes new challenges also. The growing use of AI and tokenization adds complexity when it comes to data privacy, cybersecurity regulations. With digital platforms, the risk of cyber attacks is real, and these breaches could expose sensitive client information, leading to firms' reputations. That is the reputational risk. And I would say let's not forget about the advisor skills that needs to keep up with the addition and evolving technology. It's no longer just about knowing the ins and outs of traditional investment products. The advisors now need to understand technology that goes behind these tools to offer client informed and strategic advice as the landscape is evolving. So while these technologies bring amazing benefits, more personalized services, greater efficiency, and wider market access, they also come with challenges that demand financial advisors to be adaptable, upskill, and stay ahead of the curve.
Understood, Avinash. You are essentially saying new technologies have changed, but there has to be guardrails and controls effectively in place
Absolutely.
to
Absolutely.
see. You
Absolutely.
mentioned about tokenization, and I want to take it from there. How does fractionalization uh, help in portfolio diversification as well as in terms of risk management?
Yeah. So when we talk about fractionalization, it's really transforming the way people can access high asset likes real estate and private equity and even fine arts for that matter. Traditionally, these assets were reserved for those with serious capital, people who could meet the high investment minimums, I would say. But now with fractionalization, these being broken down into smaller tradable units. No longer these millions needs to be invested in your private equity funds or luxury properties, right? You can now own a fraction of these high value assets at a much lower entry point, right? And that thus this is democratizing access in the way we have never seen before. But it's not just about the access, right? It's also solving the problems of illiquidity. Selling real estate or private equity has always been a lengthy and costly process. By fractionalization, these especially through tokenization on the blockchain DLT platform, investors can now trade fractional units much more easily with increased liquidity in the market than the traditional illiquid setup that was there. Now, in terms of portfolio diversification, fractionalization lets investor diversify across wider range of asset classes. Instead of sticking to just stocks and bonds, you can now own shares in the diversified alternative assets, right? This has opened up new opportunities for growth and diversification. From risk management perspective, by investing in fractional units across diversified types of asset, investor can are, I would say, able to spread their risk effectively across multiple sectors, diversifying real estate, private equities, helping cushion portfolio from your market volatility. And another key point is fractionalization gives investor access to high risk and high return assets like cryptocurrency and venture capital without having to commit huge sum. You can still benefit from potential gains, which while limiting your exposure, the riskier part of these investments also, right? So in short, fractionalization is democratizing access to high value assets, while reshaping how we think about diversification and risk management in the portfolio.
Understood. Understood, Avinash. See, Effie, in your previous response, you briefly touched upon the demographic change. And how does that demographic change? Do young investors expect more information, more knowledge, and demands it places on the financial advisor while engaging with them?
That's a great question, and it's all about changing the way relationships are built through the channels that we use now, which are omni channels, because mainly of mobile. But it is not only the channel, it's the nature of the communication that changes. The younger generation is very much focused on transparency. So that has to be built into the relationship, whether it's transparency around fees and costs, or whether it's transparency on how risk management or portfolio allocation is done. It's also about meeting the customer at the channels that they frequent. So be it social channels, like Instagram, and it's also finding effective ways through those communication channels to offer bite-sized financial education. And again, there, the art is to do that in a way without sort of selling products, but really accompanying your clients along the journey that takes them to the final decision to invest. And even incumbents, there's a great example. Bank of America has understood this qualitative change in terms of how to build relationships. And that's why they have launched the Bank of America Academy, which is coaching advisors, financial advisors, on how to build these relationships and how to communicate with the younger generation.
Very nice. Very nice, Effie. See, Avinash, given the emerging technologies center stage and also the demographic change and the need for how to communicate or engage with them, what do you think are the skills, capabilities, and knowledge that the financial advisors need to have in order to meet the demands of their investors?
This is the place where the financial advisors need to shift their gears. They need to shift from just being an advising to actually educating the younger generations, right? As why advisors should indulge in creating interactive platforms with self-learning tools, especially around alternative investments. They need to explain not just the assets themselves, but the entire ecosystems, how these investments works, who the players are, and how they help with risk diversification. For example, in our wealth report, right, the it's mentioned that the millennials are increasingly interested in ESG focused alternative assets, right? Advisors can guide them by using real time data and how these investments impact their portfolio. And let's not forget the technology aspect further that was involved into this. Advisors should be work on building AI powered tools that personalize financial plans and automate strategies. Have in develop client portals where young investors can track their investments in real time, get performance updates, and even have an interactive chatbot that could answer instantly things like market trend information, right? At the end of the day, it's about merging the human touch with tech driven experience for the advisors. They need to engage, educate and empower these younger investors. But do it in a way that's more digital, seamless and personal. That's the kind of service that will, I believe, resonate with the newer, younger generations today.
Understood, Avinash. See, Effie, we covered a lot of ground in terms of the demographic change to investors, to the technology change, to the rise of alternative assets and things like that. What would you say would be the key takeaways for the C-suite wealth management firms from this report?
I would say that there's probably three or four main takeaways, starting from the technological part. C-suite should be completely on board around technological integration in the business, because that is the only way to provide the kind of service that is needed in this type of environment. The second thing is that everything should be more proactive and personalized. And therefore, forget about quarterly reports and quarterly updates and, standardized templates and so on. Here we're talking about being proactive and offering client engagement that is personalized. The third aspect that is equally important is being informed and up to date about all the regulatory changes, especially around the areas that we spoke about, ESG and all the alternative assets, tokenized assets, digital assets, and so on, not only because of the reporting needs, but because these are part of the financial education real time that we spoke about. And the last but not least is really recognized in the business strategy and the technological integration that the priorities of investors have changed. The 60-40 classic portfolio no longer cuts it. It includes, Vinash talked about it more extensively, it includes alternative assets, it includes ESG priorities, it includes cryptocurrencies and tokenized assets as a growing asset class. So those are the four areas.
Excellent, Effie. Now, Avinash, do you have some last words on this?
Sure. So C-level executives must ensure that their organization invest in machine learning, tokenization, Gen AI technologies to meet the growing expectation of clients who demands tech-driven advisory services. Executive need to support team in building expertise in alternative asset area. C-level executive need to integrate ESG framework into their organization's advisory models and ensure that their advisors are well versed in the latest ESG regulations and trends. Mm, they need to foster an environment where advisors can balance high-tech solution with a high-touch approach. The emphasis should be on training advisors to improve their soft skills, communication, emotional intelligence, to deepen client relationship. In summary, I would say education and upskills are critical. The evolving wealth landscape requires advisors to continue to learn and adapt. The executive must prioritize ongoing training programs that helps advisors stay ahead in this market trend.
Thank you, Avinash. Essentially, Effie and Avinash, if I pick it up, literacy is not only for the investors but also for the financial advisors, because industry is changing. All of them need to learn, grow, adapt. Thank you very much.
Thank you.